There, accountants, I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover Chapter 11, Liabilities Bonds Payable from Financial and Managerial Accounting, 16th edition. By the end of this chapter, you should be able to describe the characteristics and terminology of bonds payable, describe and illustrate the accounting for bonds payable, describe and illustrate the reporting of bonds payable, describe and illustrate how the times interest earned ratio is used to evaluate a company's financial condition. In Appendix 1, we'll determine the selling price of a bond payable using present value concepts. And Appendix 2 will describe and illustrate the effective interest rate method of amortizing bond discounts and premiums. So with the first learning objective, we're going to learn the nature of bonds. What are bonds? So we think of big corporations. We think of Pepsi. We think of Amazon, these really big corporations. So obviously they're earning and generating revenue from their sales. But when they want to finance their operations, there are more than one option as a C corporation. They can choose to issue stock where they give individuals or other businesses ownership in the company, or we have what's called bonds. And bonds, as we're going to learn in this chapter, this is basically where individuals and businesses lend money to a corporation. So a bond is essentially a form of an interest-bearing note. And like a note, a bond requires periodic interest payments with the face amount to be repaid at the maturity date. So as it relates to these bonds, essentially, they are borrowing money from individuals and businesses, and they are essentially saying, hey, if you let us borrow this $100,000, we promise that we're going to pay you 6% for as long as we are holding the bonds. That essentially makes individuals and businesses a creditor of the corporation, and bondholders' claims on the corporation's assets rank ahead of the stockholders. So let's say in the event that a business has to liquidate or they're going into bankruptcy, before they pay anything to the stockholders, those who have ownership in the company, they first pay the creditors, which are the bondholders, those that lent money to the corporation. So as it relates to corporate bonds, they normally differ in the face amount, interest rates, interest payment dates, and maturity dates. And bonds also differ in other ways because sometimes they might have corporate assets pledged in support of the bonds. So if we think about a car note, right? When you have a car note, in the event that you stop paying the car, no, what is going to happen? They're going to come and they are going to repossess the car. Same thing with a mortgage, right? With a mortgage, you have the note, you are promising to pay, but in the event that you for whatever reason, stop paying the mortgage, in such case, they are going to foreclose on the home. They're going to take the asset that is tied to that note. So same thing with certain bonds, in the event that the corporation that borrowed the money does not pay it back, the creditors, the bondholders, they will receive the assets in place of receiving the cash that was invested. So some characteristics and terminology to be aware of. A bond issue, it's normally divided into a number of individual bonds. And the face amount, that's called the principal. So the principal, that's essentially the amount that's going to be repaid on the date that the bonds mature. Often the principal is usually $1,000, or it can be a multiple of $1,000. This is the amount again, that must be repaid on the dates that the bonds mature. And then we have what's called a bond indenture. So if you get that car loan, there's going to be some type of contract. The mortgage, you close on a home, there's going to be some type of contract that's specifying the amount that was borrowed, the interest rate, the payments, and things of that nature. Because if not, who's to say that this individual really did borrow this money to purchase this asset? In the same way, for a bondholder, when they are lending money to the corporation, there's an underlying contract between the company that's issuing the bonds, borrowing the money, and the bondholder, and that is called the bond indenture. The two most common types of bonds are term bonds and serial bonds. When all of the bonds of an issue, if they all mature at the same time, then in such case, they are called term bonds. So that would essentially be if every bond that the corporation issued, they are all going to mature in 5 years, that would be considered term bonds, versus if they mature over several dates. So maybe they have 3-year bonds, 5-year bonds, 10-year, 20-year bonds. In such case, those would be called serial bonds. There's also some more complicated bond structures. So convertible bonds, these are in cases where bondholders can exchange some of their bonds for shares of common stock. So they invest money into the corporation, and then they would also have borrowed money or lent money rather to the corporation. So they have a bit of both. They have ownership in the corporation, and they're also a creditor because they lent money to the corporation. So that would be like a convertible bond. And then we have callable bonds. These can be redeemed by the corporation prior to maturity. Proceeds from issuing bonds. So whenever the corporation issues bonds, the proceeds received from the bonds, it depends on a few things. The face amount of the bonds, the principal amount. Again, this is the amount that's going to be due at the maturity date, the interest rate on the bonds, and the market rate of interest for similar bonds. The face amount and the interest rate on the bonds, they're going to be identified in the bond indenture. So it'll be specified the amount, 10,000, 100,000, whatever that amount is, and the interest rate that the corporation promises to pay. That's often called the contract rate. And then the interest rate to be paid on the face amount, again, that's the contract rate or the coupon rate. And then we also compare it to the market. That's the market rate of interest, and sometimes it's called the effective rate of interest. And it's determined by the sales and the purchases of similar bonds. Because again, if we have Corporation A and Corporation A is paying interest on their bonds of 10%, and Corporation B is paying interest of 11% on their bonds, a person might think, hey, you know what? Let me go with Corporation B because they're paying more interest. And because of that, corporations, they'll generally issue their bonds at a discount. If there's a higher demand, they will issue it at a premium. And in a very, perfect world, that's when it will be issued at face value. Because again, sometimes there's differences in timing when the bond indenture was put into place and all of these different things. So for the most part, bonds are often either issued at a discount or at a premium. And as it states here, the market rate of interest, it's affected by a variety of factors, including investors' experience and expectations of current and future economic conditions. If the market rate equals the contract rate, bonds are going to be sold at a face amount. In the event that the market rate, and that is essentially with the previous example that I just gave, the market is paying more than the corporation, there's a less demand, right? So much like if you go to the grocery store, you generally see discounts when there's less demand or there's a plethora of supply. So to get rid of it, they essentially sell things at a discount, versus if things are scarce, it is being sold at a premium. So same concept. If the market rate is greater than the contract rate, the bonds are going to sell for less than their face value. And the face amount of the bonds less the selling price is called a discount. A bond sells at a discount because buyers are not willing to pay the full face amount for bonds with a contract rate that's lower than the market rate. Because again, they'll say, why am I going to lend my money to this corporation and they're only giving me 10% versus a corporation, or if I go to the market, I'll get 11%, right? So they need to incentivize the bondholders. And in the event that the market rate is less than the contract rate, the bonds are going to sell for more than their face value, and that is called a premium. A bond sells at a premium because buyers are willing to pay more than the face amount for the bonds with the contract rate that is higher than the market rate. So that would be vice versa with the first scenario we gave. Let's say Corporation A is now paying 11% and the market is paying only 10%. So in such case, the individuals that buy the bonds from Corporation A, they are willing to pay a premium because the interest is higher than the market rate. So this is just a visual depiction of issuing bonds at a discount, at face amount, and at a premium. So again, market rate less than the contract rate sold at a premium. When the market rate is equal to the contract rate, it sells at face amount. And when the market rate is greater than the contract rate, it's sold at a discount. So as it relates to accounting for bonds, it is very, very important to track. Why? Again, If a corporation is not properly tracking who they owe, how are they going to know how much interest they paid thus far? How are they going to know when it matures? How are they going to know the carrying value and things of that nature? So as we know, bonds can either be issued at their face amount, a discount, or a premium. And when bonds are issued at less or more than their face amount, the discount or premium needs to be amortized over the life of the bonds. And at maturity date, the face amount, the principal amount that was borrowed, is going to be repaid. So we have this example here. If the interest rate, the market rate rather, of interest is equal to the contract rate of interest, the bonds, they're going to sell for their face amount or at a price of 100. So we have this example, January 1st, 20-year 5. Eastern Montana Communications, Inc., they issued the following bonds. The face amount is 100,000. The contract rate of interest is 12%. Interest is going to be paid semi-annually. That means that they are paid twice a year. And here it states June 30th and December 31st. The term of the bonds are 5 years. So the bonds mature in 5 years. And the market rate of interest is 12%. Again, it's equal. So therefore, since the contract rate of interest and the market rate of interest are the same, the bonds are going to sell at their face amount. And the journal entry to record the issuance of the bonds is as follows. So as we are looking at this journal entries, it is very important to ensure that your foundational understanding of the fundamentals of accounting basics are in place. Why? Because you'll look at this journal entry and say, wait, what? Why are we debiting cash? And why are we crediting bonds payable? So as we know, anytime we need to increase an asset account, I don't care if it is cash, if it's accounts receivable, if it's equipment, anytime there's an increase to an asset account, it must be debited. Vice versa, anytime we need to credit, or anytime we need to decrease rather the balance in an asset account, we must credit it. So as it relates to the various account types, think of it like a coin. A coin has two sides. It's either heads or tails. As it relates to accounting, the various accounts that are listed in the chart of accounts, one side increases and the other side decreases. As it relates to debits and credits in accounting, debit simply means left, the left side of an account, and credit means right, the right side of an account. And depending on that account, if we debit or credit it, it might have a different impact. So for asset accounts, anytime we debit these accounts, it shows an increase. If we credit an asset account, it shows a decrease. And that is in comparison to our liabilities and stockholders' equity accounts. Anytime we want to show an increase to these types of accounts, liabilities and stockholders' equity, we have to credit it. Therefore, if we want to show a decrease to our liability or stockholders' equity account, we must debit those accounts. All right, so this journal entry, we debit cash for 100,000. We're showing an increase to our asset, and we credit bonds payable. We increase our liability at 100,000. And we have our quick description here. We issued $100,000 bonds payable at the face amount. And now the next thing that we need to record, because in the life of a bond, there's 3 key things we need to factor in. 1, we need to record the date of issuance, as we just saw on the previous slide, the date of issuance. And then during the term of the bond, in this case, it's a 5-year bond. It could be 20, 30 years, however long it is. We also need to record the interest payment. And then lastly, we need to record the maturity date. So these are the key events that happens within the life of the bond. So here, as we know, they're making payments semi-annually every 6 months, June 30th, December 1st, after the bonds are issued. So here, in order for us to calculate it, we know that the face value of the bonds is $100,000, and we're promising on a yearly basis that we are going to pay them 12%. But here's the thing, we're not paying them all 12% at once. We're making the payment twice a year. So we can do 2 things. We can either just decide, hey, I'm going to divide the 12% by 2, which is 6%, or we can multiply the face amount, which is 100,000, by the annual interest rate, which is 12%. We'll get the total interest for the entire year, and then we divide it by 2, or 50%, right? So in such case, the first journal entry is going to be as follows. We debit the interest expense account for $6,000, and we credit cash for the $6,000. So as mentioned, we know that our cash is decreasing. Cash is leaving the business. So therefore, we credit cash for the 6,000, and our interest expense. Remember, interest expense is a part of our stockholders' equity, and money is leaving the business. Therefore, our equity is decreasing. Hence the principle that I mentioned earlier about stockholders' equity being increased with a credit and being decreased with a debit remains the same. So we debit interest expense and credit cash for 6,000. The only thing that might change with this journal entry is in the event that we accrue the interest. So accrued interest, accrued expenses, that generally represents expenses that have been incurred but not yet paid. So because it was incurred and not yet paid, think about it like a phone bill, right? You incur the expense, you just didn't pay for it as yet. So in such case, we have a liability, we have an obligation to pay for the expense. So the only difference would be if we didn't pay the interest right away, instead of crediting cash, we would credit the interest payable account, which is a liability. So that's in the event that the interest was not paid right away. So this is the last thing we need to consider, the maturity date, where we are repaying the $100,000. And if you notice, we are simply reversing the original entry we made. We are now debiting our bonds payable. We're decreasing our liability. So now the balance is going to be zero. Originally, the balance in the bonds payable was $100,000 credit. And now we have a debit of 100,000. So 100,000 minus 100,000 is zero. And for our cash, we're crediting cash because our cash is decreasing. So with our bonds being issued at a discount, again, that was in a scenario whereby we were issuing the bonds at face amount. But again, generally doesn't happen. So here we see bonds issued at a discount, and if the market rate of interest is greater than the contract rate of interest, the bonds are going to sell for less than their face amount. And this is because, again, investors, they're not willing to pay the full face amount. If I can go into the market, purchase bonds for a similar company and they're going to give me 12% interest, why am I going to give you my money when you're only giving me 10% interest? Just doesn't make sense, right? So again, what corporations will do is they want to appease the bondholders because, again, this is a part of the way in which they finance their operations, the way in which, they stay afloat, the way in which they can expand the business. So therefore, they provide an incentive to the bondholders, the creditors, by saying, hey, okay, I understand, you can go into the market and receive 12%, and we're only promising to pay 10% interest, but here's what we'll do. The bonds are worth $100,000. We'll sell it to you for $95,000. So now the person is thinking, you know what? I'm not getting as much interest, but I'm not paying the full face value, but in 5 years, 10 years, whatever the years are, I'm going to get $100,000. Hey, sounds like a deal to me. All right. So here we have this example. We have Western Wyoming Distributions, Inc., and they issued the following bonds. The face amount of the bonds, 100,000. The contract rate of interest, this is the rate that Western Wyoming Distribution, Inc. is promising to pay the bondholders. The interest is going to be paid semi-annually. We know that that's twice a year, 5-year bonds. And the market rate of interest, similar bonds are paying 13%. So again, bondholders are looking at it like, why am I going to give you my money? So Western decides to provide them with an incentive. Because the contract rate of interest is less, the bonds are going to sell at less than their face amount. So in such case, we say, assuming the bonds sell for $96,406. So again, the bonds are worth $100,000. We credit bonds payable for the full amount because, again, when we repay at the maturity date in 5 years, we're still giving them the full $100,000. We basically just had to, eat the cost pretty much to borrow the money. So we only received cash of $96,406, and we're going to pay them back $100,000. But we know one thing about accounting: total debits and credits must tie. So here we're introducing this new account, which is called discount on bonds payable. And this discount on bonds payable is a contra liability account. So essentially, as we see here, both are a liability account. We have our bonds payable, which has the credit of $100,000, and we know for our liabilities, Debits for liability accounts represent a decrease. So when we net the two, this $100,000 and $3,594, the carrying value of the bonds is $96,406. And now when we're dealing with discounts and premiums, we're going to have to do what's called amortize. We're going to spread the cost out, or in this case, the discount out over the 5-year period. If there's two options, there's a straight line option, and we also have the effective interest rate method, which is based on a carrying value. So the $96,406, this is the amount investors they're willing to pay for bonds that have the lower contract rate of interest than the market, which is 13. The discount is the market's way. Again, you're basically adjusting the contract rate of interest to the higher market rate of interest. The account discount on bonds payable, as mentioned, it's a contra account because, again, it's contrary to the nature of accounting. Generally, liabilities have a credit balance, but this discount on bonds payable, its normal balance is contrary to the normal rule. It is a debit balance. It is subtracted from bonds payable, and it helps to determine the carrying amount or the book value of the bonds payable. And as mentioned previously, the carrying amount of the bonds payable is the face amount of the bonds less any unamortized discount or plus any unamortized premium. So once bonds are being issued at a discount or a premium, we're going to explore this fundamental concept of amortization. So as it relates to amortizing a bond discount, every period, a portion of the bond discount is going to be reduced, and it is going to be added to interest expense to reflect the passage of time. And this process is called amortization. So amortization is fairly similar to depreciation, whereby we have an asset. Over time, we are basically absorbing the cost. We are recouping the cost, allocating the cost rather, over a number of periods. So this process called amortization, it increases the contract rate of interest on a bond to the market rate of interest that existed on the date that the bonds were issued. The entry to amortize the bond discount is as follows. So the first thing we do, we debit interest expense and we credit the discount on bonds payable account. The preceding entry, it can be made annually once a year as an adjusting entry, or it can be combined with the semi-annual interest payments. And in the latter case, where we record the journal entry every time we issue an interest payment, in such case, the journal entry is going to be as follows. We debit the interest expense, we credit discount on bonds payable, and we credit cash, which is the amount that we promise that we are going to pay our bondholders based on the contract rate of interest. And as mentioned, there are two methods of computing the amortization of a bond discount. We have what's called the straight line method of amortization, and this provides equal amounts of discount or premium to be written off to interest each expense period. So think of this like straight line depreciation, right? We purchased an asset, the asset is worth $2,000, and we depreciate it over 4 years. Every year, we are claiming a depreciation expense of $500. It's easy, straightforward. The effective interest rate method, however, is a bit more involved, right? So the effective interest rate method, sometimes called the interest method, this method is required by generally accepted accounting principles, GAAP. And as it states here, the method is going to be discussed more in Appendix 2. And we'll see it in practice now as we record the journal entries. So amortization of the Western Wyoming distribution bond discount of $3,594 is going to be computed as follows. So the discount on the bonds payable, again, the bonds cost, the principal, the amount to be repaid at maturity is $100,000, but they only paid us $96,406. So therefore, the discount on bonds payable is $3,594. So if we choose to use the straight line method, fairly straightforward, right? The term of the bonds is 5 years. But again, how many times are we making payments per year? 2 times a year. So 5 times 2 represents 10 payments. Therefore, if we divided the 3,594 divided by 10 periods, 5 years multiplied by 2 payments per year, the semi-annual amortization would be $359.40. So after the 10-year period, the balance in our discount on bonds payable account would be zero, and the face value, the carrying value of the bond, would be equivalent to the $100,000. So this would be our journal entry. We would debit the interest expenses. Sometimes it's like it's a plug-in essentially. So there's a few things we know. One thing you always want to do, especially in accounting, you use what you know to figure out what you don't know. So what we do know is that they promised that they are going to pay 12% interest on $100,000 bonds twice a year. So $100,000 multiplied by 12% is $12,000. But again, they don't pay the lump sum all at once. They pay it twice a year. So 12,000 divided by 2 is 6,000. So we know cash is going to be paid of 6,000. And we just figured out that the discount on bonds payable, the discount was $3,594. It's 5-year bonds. Payments are made twice a year, so we divide it by 10. Therefore, our discount on bond payable is going to be amortized by $359.40. So we add the cash plus the amortization of the discount on bonds payable, and that gives us our total for the interest expense. So the effect of the discount amortization is to increase the interest expense on every semi-annual interest payment date. And in effect, this increases the contract rate of interest to a rate, again, that approximates the market rate. So as I mentioned previously, hey, they realize that, yeah, they're not paying us as much in interest, but we're not paying as much to get the bond, and we're still getting the face value. So therefore, it kind of sort of, works out the same. As the discount is amortized, the carrying amount of the bonds increases until it equals the face amount of the bonds on the maturity rate. So that kind of sums up amortizing a bond discount. Now we move on to bonds issued at a premium. So if the market rate of interest is less than the contract rate of interest, the bonds are going to sell for more than their face amount. So this is because the investors, they want to pay more for bonds that are going to pay a higher contract rate of interest than the rate that they could earn on similar bonds. So we have this example. We have Northern Idaho Transportation. They issued the following bonds. The face amount is $100,000. They are promising to pay 12%. Interest is paid semi-annually. These are 5-year bonds, and the market is only paying 11% interest. So because the contract rate of interest is more than the market rate of interest, the bonds are going to sell for more than their face amount. So here it states, assume the bonds sell for $103,769. So in light of that, the entry to record the issuance of bonds is as follows. We debit cash. Why? Again, because it is an asset account and we want to show an increase to our asset. We credit bonds payable at the end of 5 years. We're going to pay them back $100,000. But hey, we're paying more than the market, so they gave us some premium. So in such case, the $3,769 that they gave us in addition is going to be recorded in the premium on bonds payable account. And this is a separate account to essentially track the premium that was paid for the bonds. And the premium is essentially the market's way of adjusting the contract rate of interest to lower the market rate of interest. And the account premium on bonds payable has a normal credit balance. As mentioned, liabilities, their normal balance, the side on which an increase is shown, is a credit. And this amount in the premium on bonds payable, it's added to the bonds payable to determine the carrying amount or the book value of the bonds payable. So much like bond discounts, bond premiums, they need to be amortized over the life of the bond. The amortization of a bond premium, it decreases the contract rate of interest on a bond to the market rate of interest that existed on the date that the bonds were issued. And similar to amortizing a discount, they can be computed using either the straight line method. Again, think of it like the straight line method of depreciation. And I think they use straight because it's straightforward, right? The effective interest rate of method, on the other hand, we need to know what the carrying value is for the bond in order to determine how much the interest rate is going to be, how much the interest expense rather is going to be, and that ultimately ties into how much of the bond premium or bond discount is going to be amortized. So the entry to amortize a bond premium is as follows. We debit premium on bonds payable to decrease the balance, and we credit interest expense. And the preceding entry could be made annually, or it can be combined with semi-annual interest payments. So every time an interest payment is made, we can essentially just record the amortization of the bond premium, and it would look as follows. We would debit interest expense, debit premium on bonds payable, and we would credit cash for the amount, again, that we are promising to pay our bondholders. So the amortization of the preceding premium, the amount was $3,769. And again, this is using the straight line method. They are 5-year bonds, but we are paying the premium, or we're paying interest rather, twice a year, so 5 times 2, and that is why we are dividing by 10. So the semi-annual amortization is $376.90. So the combined entry to record the first interest payment and the amortization of the premium is as follows. Again, we know we promised to pay $6,000 in cash. That does not change. Whether we issued the bonds at a discount or premium or face amount, the amount that we promised to pay is the amount that we are going to pay. So we credit cash for $6,000, and we already calculated our premium on bonds payable debit. So in order to determine, again, the interest expense is kind of like a plug-in. So in order to determine the interest expense, we subtract the cash we promised to pay minus the premium on bonds payable, and that difference represents our interest expense for that period. So the effect of the premium amortization is to decrease the interest expense, and the decrease to the rate of interest approximates the market rate. Again, so they basically work hand in hand, whether it's a discount or a premium, they both essentially approximate to the market rate. And as the premium is amortized, the carrying amount of the bonds, they are decreased until it equals the face amount of the bonds when they mature. So next we have what's called bond redemption. As mentioned, sometimes it can get a little complex. So when we're dealing with bond redemption, sometimes corporations, they may decide to redeem or call the bonds when they mature, or before rather they mature. So sometimes it's done when the market rate of interest declines below the contract rate of interest. And in such cases, the corporation, they might decide, hey, you know what? We promised that we were going to pay 10%. And now the market is only paying, let's say 7%. Let's, take these bonds back, and let's, issue new bonds at a lower interest rate. So that's an example when a corporation might decide to redeem rates. We have what's called callable bonds, and these are the bonds that can be redeemed by the issuing corporation within the period of time and at the price that was stated in the bond indenture. And normally the call price is above the face value. And a corporation, they might also decide, hey, you know what? We're just going to purchase our bonds by purchasing them on the open market. So similar to treasury stock. A corporation, they'll usually redeem their bonds at a price that's different from the carrying amount or the book value of the bonds. And depending on, how much they purchased it for, they'll record a gain if the price paid for the redemption record a gain if the price paid for the redemption is below the bond carrying amount, and they'll record a loss if the price paid for the redemption is above the carrying amount. And then there's some gains and losses on a redemption of bonds, and those will be reported in the other revenue or other expense section of the income statement. So here we see, assume that on June 30th, the corporation has the following bond issuance. So we have bonds, the face amount is $100,000, and the premium on bonds payable is $4,000. So on June 30th, the corporation decided to redeem 1/4, $25,000 of these bonds in the market for $24,000. So in such case, the journal entry to record the redemption would be as follows. So the corporation redeemed 1/4, $25,000. So we debit our liability account because we're decreasing the balance. Again, we are redeeming them. And then we are crediting cash because that's how much we paid. And now again, we want to keep in mind, hey, we're factoring in the premium on bonds payable, and we are also factoring in the gain on the redemption of the bonds. So all of these different things are essentially going to be factored in. when the bonds are going to be redeemed. Only the portion of the premium that's related to the redeemed bond is going to be written off, and the difference between the carrying amount of the bonds redeemed and the redemption price is recorded as a gain. Here we see it states that assume the corporation calls the remaining $75,000 of the outstanding bonds and they're held by a private investor for $79,500 on July 1st. The entry to record the redemption is as follows. So again, the value of the bond was $75,000. And then we see here, the cash, we paid $79,500. And then if we factor in the value of the bond, so here we see the bonds payable was $75,000, the premium was $3,000. So if we add the two, that gives us $78,000. So $78,000 versus how much we sold it for. That is why we have a loss of $1,500. So again, we compare the amount paid, we compare the bonds payable and the premium, which represents the carrying value or the book value of the bonds, and the difference between the carrying amount of the bonds, as we mentioned, and the redemption price is recorded as a loss in this case. So here we start to look at the reporting of the bonds payable. So as we know, liabilities are reported on the balance sheet. So for those of you that ever find yourself confused, not remembering which financial statement they're reported on, think about aloe, right? My family is from the Caribbean. They are from Guyana. And there's this plant. You might have seen it before when you went to the supermarket. It looks like a really long triangle, and it's very bitter. Right. But one of the reasons why they, eat or sometimes drink this very bitter, I want to call it a vegetable, might be a fruit, not sure. But, the reason why they eat this bitter item is because it helps with your blood, right? It cleans out your blood. It helps to balance out your body. So for me, a mnemonic to help me remember which accounts are reported on the balance sheet is aloe. Aloe, when I think of aloe, I think of balancing the body. So A stands for assets, L stands for liabilities, and O stands for owner's equity. So when we think of the balance sheet, we think of aloe, and that is how we remember which accounts will be reported on the balance sheet. So bonds payable, again, reported as liabilities on the balance sheet. Any portion of the bonds that's going to be due within a year is reported as a current liability, and any remaining bonds are going to be reported as long-term. It's more than 12 months. Any unamortized premium is reported as an addition to the face amount of the bonds, and any unamortized discount is going to be reported as a deduction from the face amount of the bonds. And a description of the bonds should also be reported on either the face of the financial statements, or they can be reported in the accompanying notes. So here we see the reporting of bonds payable for PepsiCo. Here we see accounts payable and other current liabilities. We have current maturities of long-term debt obligations, and we have other debt obligations. And as we see here, it's specifying exactly the current maturities of long-term debt obligations. And here we see with PepsiCo continued, it essentially lets us know we have some bonds that are maturing 2020 all the way up to 2049, essentially, and others that are due all the way up to 2026. So again, these would be an example of serial bonds because they don't all mature at the same time. So now we move on to learning objective 4, an analysis or decision-making time interest earned. So the assets of a company, considering, let's say, maybe the company liquidates, right? The claims of the creditors and the rights of the owners are not essentially the same. So as creditors, bondholders, they are primarily concerned with what is the company's ability to pay their interest payments and pay the amount at maturity, right? Because think of it in your everyday life. When you lend somebody money, whether it's a friend or family, if they are borrowing the money, you want to get the money back, right? So same thing, investors, they want to be very, wise when they are making this decision to lend money to a corporation. So this essentially is a tool that is used before investors decide to invest in a corporation. So analysts, they assess the risk that bondholders will not receive their interest payments by computing the times interest earned ratio during the year as follows. And here it says times interest earned equals income before income tax expense plus interest expense divided by interest expense. So let's make this even more practical, right? We think about in our everyday life, credit. Right? So let's say you want to purchase a home or get a car or something like that. Generally, they deem your credit or your trustworthiness to lend you money by your credit score. It's kind of the same thing, right? If you have a very low credit score, your credit score is like 300, 400, they're going to say, hey, you know what? I don't think I'm going to lend you any money. Why? Because there's a likelihood that you're not going to pay back versus someone with a 800 credit score, 850 credit score, they're more likely to lend the money to you because you are deemed trustworthy with money based on your credit score. Essentially the same thing, right? Analysts, they are assessing the risk. Is the corporation going to pay the interest and repay the principal amount at maturity date to the bondholders? So that's this analysis, this ratio times interest earned. Again, income before income tax expense plus interest expense divided by the interest expense. So this ratio computes the number of times interest payments could be paid out of current period earnings. High values of this ratio obviously considered favorable. In contrast, low values are considered unfavorable. So generally within the industry, values of this ratio less than 1.0, that suggests that the firm is unable to cover interest payments from income before tax. So obviously, if the times interest earned is below 1, an investor is probably going to say, you know what, I'll pass. I don't want bonds from this corporation. So such a situation could eventually lead to loan defaults. So here we have the following data was taken from recent annual reports of 3 companies in the soft drink beverage industry. We have Pepsi, we have Coca-Cola, and we have Keurig Dr. Pepper Inc. So we look at Pepsi, we look at Coca-Cola, and we look at Keurig Dr. Pepper. We consider their interest expense and their income before income tax expense. So based on this information, we see that the times interest earned for PepsiCo is 9.2, for Coca-Cola is 12.4, and for Keurig is 3.6. So among these 3 companies, Keurig has the greater interest coverage in comparison to Pepsi and Coca-Cola. The key thing we see is that, all of the companies, they generate enough income before tax to pay to essentially cover their interest payments, essentially, right? So pretty much all companies, they're in a good space. So now this brings us to Appendix 2, where we consider the present value concepts and the pricing of bonds payable. So again, the corporation, whenever they are issuing it at a discount or at a premium, they're considering the present value concepts in order to determine how much of a discount should be provided and how much of a premium should be provided. So when a corporation issues bonds, the price that investors are willing to pay for the bonds depends on the following: the face amount of the bonds, which is the amount that's going to be due at maturity, the periodic interest that's going to be paid on the bonds, as well as the market rate of interest. An investor determines how much to pay for the bonds by computing the present value of the bond's future cash receipts by using the market rate of interest. In a bond's future cash receipts include its face value at maturity plus the periodic interest payments over the life of the bond. The concept of present value is based on the time value of money, because pretty much $1 today is not worth $1 2 years from now, right? Or $1 today is not as the same as $1 2 years ago, essentially. So the time value of money concept, it recognizes that cash received today is worth more than the same amount of cash that's going to be received in the future. So the present value of an asset or cash at present that is equivalent in value to a specified sum in the future. And future value, on the other hand, is the value of an asset or cash at a specified date in the future that is equivalent to a specified sum today. So here we just have a quick exhibit. Again, $1,000 today, if it's going to be received 1 year from now, it's going to be worth $1,100 versus the present value of an amount to be received in 1 year. Based on that, I'll say, hey, if I want to receive $1,000 a year from now, I don't need to invest 1,000, right? Again, obviously based on the interest rate. So what you would say is, if I want 1,000 a year from now, I really only need to invest $909.09, pretty much, right? So that's the importance of the present value and future value. Here we see, let's say the individual wants to receive the $1,000 2 years from now, not 1 year from now. And again, the interest rate is still 10% instead of $909.09, because it's 2 years from now. Today, we only need to invest $826.45. So obviously, the longer period of time, the lesser amount needs to be invested. So the present value of an amount to be received in the future, it can be determined by a series of divisions. And it's essentially easier to use a table of present values. The present value of a dollar table is going to be used to find the present value factor for a dollar to be received in the future after a number of periods. And the amount to be received is then going to be multiplied by the factor to determine what its present value is. So here we have a chart. Present value of a dollar at compound. So here we see at the top, it shows us the different interest rates. So obviously, that has an impact. Are we going to receive 4%, 4.5%, 5%, 5.5%, etc., all the way up to 13? And then the period represents the number of periods. And keep in mind, when we're dealing with semi-annual interest, if it is a 5-year bond and they are paying payments twice a year, there's 10 periods of payments, not 5. So it's very, very important to keep that in mind. It's going to be based on the number of years in addition to the number of payments. So here we see the present value of an annuity. So a series of equal cash receipts spaced out over a number of years, that's called an annuity. And the present value of an annuity is the sum of the present values of each cash receipt. And the present value of an annuity, it can be computed in a single step. So using a present value from the present value of an annuity of a dollar table in the Exhibit 7, which we just saw, the present value of that entire amount, it can basically be determined by multiplying the equal cash payments times the appropriate present value of an annuity of a dollar. So here we just have another visualization. Again, we want $1,000, and then it's basically letting us know, or in this case, if we deposit $100 today and we want it a year from now, we only need to deposit $90.91. And if we want $100 at the end of 2 years, we need to deposit $82.64. All right. So again, that's the benefit of using the present value of an annuity chart. It basically kind of factors in the time value of money. As it relates to pricing the bond, this is where all of this comes into play. So the selling price of a bond is the sum of the present values of the face amount of the bond due at the maturity plus the periodic interest to be paid on the bonds. And the market rate of interest is used to compute the present value of both the face amount and the periodic interest. And in order to illustrate the pricing of bonds, it states, assume that Southern Utah Communications, they issued the following bond on January 31st. The face amount is $100,000. The contract rate of interest is 12%. Interest is going to be paid semi-annually, twice a year, and the term of the bonds is 5 years. So assuming that there's a market rate of 12%, the bonds are going to sell for their face amount Y. The contract rate is equivalent to the market rate. So as shown by the following present value computations, the bond is going to sell for $100,000. We consider the present value of the face amount of $100,000 due in 5 years. So again, we go back to the chart. We know the interest rate, which is 12%. But again, because it's being twice a year, we divide the interest rate by 2, and we multiply the number of years by 2. So that is why we see 10 periods and we see 6%. That gives us 55,839. And then we factor in the present value of the semi-annual interest payments. And after we factor that in, and again, we are using the market rate, 44,161, the total present value of the bonds is going to be 100,000. So that's how much we're going to sell it for. Now, another scenario is in the event that we're going to sell it at a discount. The corporation is promising to pay 12%. The market is promising to pay 13%. So we need to provide an incentive to the bondholders. So in such case, the present value of the face amount, $100,000 in 5 years. Again, because the market is paying 13.5%. Now, when we divide it by 6.5, we multiply it. The present value of the maturity amount is $53,273. And then we factor in how much we are promising to pay the bondholders in semi-annual interest payments, which gives us $43,133. So based on that, the total present value of the bonds is $96,406. So this amount that we saw in the previous slide, this number didn't just come out of thin air. It's basically based on the present value of a dollar. Same thing with the premium. Again, the market is promising to pay 11% and the corporation is promising to pay 12%. But anytime we are determining the present value of the bonds, we always use the market rate, not the contract rate. So therefore, 11% is how much the market is promising to pay. 10 periods, again, 5-year bonds, but we're making payments twice a year. So 5 times 2 is 10. And 1/2 of the market rate, 11%, which is 5.5. So therefore, when we add these two numbers together, the total present value of the bonds being sold at the premium is $103,769. And instead of using the present value tables, sometimes it can be computed using a financial calculator or even a spreadsheet program. So here we have the formula that says the formula for the present value of cash amount is going to be labeled C to be received in N periods at the compound interest rate of I. And it is essentially computed as follows. So again, C represents the cash to be received at the end of the period. I represents the interest rate and N represents the number of periods. So this brings us to the last section for this chapter. And in Appendix 2, we covered the effective interest rate, this method of amortization, because again, this is the method that is required by GAAP. So the effective interest rate method of amortization, it provides a constant rate of interest over the life of the bonds. Because again, the discount or the premium, it needs to be amortized and it represents the carrying amount of the bond as it changes. So as a result, interest expense also changes each period. This is in contrast to the straight line because as I gave you guys the example with the $2,000 vehicle, if we're using the straight line method of depreciation, let's say it's going to last us 4 years, 2,000 divided by 4 years, we take an even $500 depreciation expense each year. Similar to amortizing a discount or a premium over the straight line, it's straightforward. However, with the effective interest rate method, the interest rate used in the effective interest rate method of amortization is going to be the market rate the date the bonds have been issued. And the carrying amount of the bonds is going to be multiplied by that interest rate to determine the interest expense for the period. And the difference between the interest expense and the interest payment, that is going to be the amount of the discount or the premium to be amortized for the period. So here we have this example for bonds that were issued. So the face value of the bonds are $100,000. The present value of the bonds were $96,406 because again, it was issued at a discount. The discount on bonds payable was $3,594. So based on this is how the discount on bonds payable is going to be amortized in column A. We have the interest paid, which is 6% of the face amount. That's the contract rate, how much the corporation promises to pay. We have B, which represents the interest expense. And again, that is based on the market rate. C represents the discount amortization, which is column B minus column A. D represents the unamortized discount, which is column D minus column C. And then E represents the bond carrying amount, which is the face value of the bond, minus D, which is the unamortized discount. So the interest expense is going to increase each period as the carrying amount of the bond increases. And the unamortized discount is going to decrease each period to 0 as of the maturity date. The carrying amount of the bonds increases from $96,406,000 over the period. So again, that is why we amortize it over the period, because once we pay back the amount that we borrowed, we don't have anything else, to give these bond holders pretty much. So yes, we issued it at a discount or a premium, but to get rid of the liability, to ensure that everything is accounted for correctly, we amortize the discount and amortize the premium. So the amortization of the discount, the journal entry would be as follows again. However much we promised we're going to pay them in cash, that amount is going to be paid. From there, the discount on bonds payable based on the carrying value, we add the 2, and that represents our interest expense for the period. So now we consider premium amortization. So again, we're using the same numbers that we saw previously. The present value of the bonds, the pricing is $103,769, and the face value of the bond is $100,000. So there was a premium of $3,769. So similar chart, right? The interest paid, we're promising we're going to pay them $6,000 over the life of the bond, 10 times. And then the interest expense is going to be based on the market rate. So this changes a bit. So we see column C, D, and E. Ultimately, at the end of the 5 years, the 10 payments, the value of the bond is going to be equivalent to the face value. So as we're amortizing the premium, the interest expense is going to decrease each period as the carrying amount of the bond increases. And the unamortized premium is going to decrease each period because, again, at the end of 5 years, at maturity, the carrying amount of the bonds is going to be equivalent to the face value. And the journal entry would be as follows. Again, we're paying them $6,000. That's how much we promised, and that's how much they're going to get. We debit the premium on bonds payable for the $293, again, which is based on the carrying value. And we debit interest expense for the difference between the cash and premium on bond payable, which is $5,707. So this brings us to the end of chapter 11, liabilities, bonds payable. So we covered a lot this chapter. Now that the lesson has ended, you should have learned how to describe the characteristics and terminology of bonds payable. Again, as we know, bonds is basically where individuals and businesses, they lend money to a corporation. We describe and illustrate the accounting for bonds payable. So again, hey, were the bonds issued for the face amount? Were they issued at a discount, or were they issued at a premium? And depending on how they were issued, that ultimately determines how we are going to account for it. We described and illustrating the reporting of bonds payable, because if they were issued at face amount, straightforward. But if they were issued at a discount or a premium, now we need to factor in amortization. We also described and illustrated how the times interest earned ratio is used to evaluate a company's financial condition. In Appendix 1, we determined the selling price of a bond payable using present value concepts. And lastly, we described and illustrated the effective interest rate method of amortizing bond discounts and premiums. So again, this brings us to the end of Chapter 11, Liabilities, Bonds Payable.